Before you retire, you should know what all of your various sources of income will be and how much you can expect to receive from each. Obviously, Social Security benefits will be one of those sources, but how much you can expect to receive depends on many factors. There are ways to maximize your benefits and get the most that you're entitled to, and there are strategies to minimize your tax burden from Social Security. The most important thing to consider in working toward those goals, however, is whether your Social Security benefits are coordinated properly with your other assets and sources of retirement income. We'll address that shortly, but let's begin with some basic facts about Social Security. Social Security is one of the few sources of income you can depend on for life. Once you start taking it, your benefits continue to your death, and the longer you live, the more you will extract from the system. For example, if your benefit starts at $2,000 per month and you live 10 more years, you will receive over $300,000 in lifetime benefits. If you live 30 more years, you'll receive over $1 million over your lifetime, assuming annual cost of living adjustments of 2.8%. That's good to know because retirees are living longer than ever. According to figures from the Centers for Disease Control and Prevention, there is a 50% chance that the average 65-year-old will live into their late 80s. For the average couple age 65, there's a 50% chance that at least one spouse will live to age 92. As you probably know, many have expressed concerns in recent years about the solvency of Social Security. That concern stems partly from the fact that people are, as noted, living longer, which means the Social Security Administration is paying out benefits longer than they had in the past. Another problem is that when Social Security started, there were approximately 40 people working and paying into the system for every one retiree. According to the most recent data, there are now only 2.8 people working and paying into the system for every one person taking benefits. Despite all this, estimates from the Old Age Survivors and Disability Insurance Program indicate the current trust fund will not be depleted before the year 2033, if no changes are made to the system between now and then. However, a reduction of about 23% to every one Social Security benefit would be necessary after 2033. So while the system is solvent for now, working Americans in their 40s and early 50s might want to keep pressure on their elected officials to address the important issue of Social Security reform sooner than later. When your Social Security benefit is calculated, it will be based primarily on two things: the age at which you apply for benefits and how much you earned over the course of your working career. Social Security looks at your lifetime annual earnings, indexes them for inflation, and picks the 35 highest years' earnings to include in the calculation formula. The earnings are totaled and divided by 35 to come up with an average. If you don't have 35 years of earnings, the missing years are considered zeros, which has the effect of lowering benefits for women who have taken time out of the workforce to raise children. They may, however, be eligible for spousal benefits. Most people know that you can take Social Security benefits anywhere between age 62 and 70. Depending on when you were born, the normal retirement age falls somewhere between 66 and 67. That is the age at which you are eligible to receive full benefits, known as the primary insurance amount, or PIA. In 2020, the eligibility age for full benefits climbed to 66 in 4 months for those born in 1956, up from 66 in 2 months for those born in 1955. If you take your benefits earlier than the normal retirement age, you will get a reduction, potentially as high as 30% of what you would have gotten by waiting. Conversely, every year that you delay taking Social Security, you get an 8% increase per year in the benefits, topping out at age 70. Based on the factors above, you can do some calculating on your own and determine approximately how much you can expect to receive from Social Security by taking advantage of a couple of different resources. You can access your Social Security statement on the Social Security Administration website at ssa.gov and use the retirement estimator, which gives you your earnings history after you enter some personal data. Alternatively, you could use one of the 3 calculators available on the Social Security website. So what about spousal benefits? The spousal benefit is 50% of the worker's PIA if the spouse applies at full retirement age. For example, Bob's PIA is $2,000 and his wife Mary's is $800. If Mary applies for Social Security at her full retirement age, her benefits will be $1,000. That's half of Bob's benefit and $200 more than Mary's benefit based on her own work record. Non-working or lower income spouses are also eligible for a spousal benefit that might be higher than their own, and a surviving spouse may also be eligible for a higher benefit. In some cases, both of these benefits can also be applied to divorced spouses. Survivor benefits can be complicated, but you should understand them because your current decisions will influence the amount of survivor benefits you may receive in the future. The 2 basic factors that influence the amount are the age at which the deceased spouse first claimed his own retirement benefit and the age at which the widow claims the survivor benefit. Here are some steps you can take before you apply for Social Security to ensure you will maximize your benefits. First thing you want to do is improve your earnings record. So, examine your earnings record from your latest Social Security statement that you can get online to determine if it's accurate, if there are any missing years, and if you can improve it by working longer. The decision of when to apply for benefits is often complicated, but critically important. It can make the difference of tens of thousands of dollars over your lifetime. The goal is to maximize income for both of you while you're both alive, and to maximize income for the survivor after one of you dies. There are several strategies for doing this, including replacing other income with tax-advantaged investments, anticipating IRA RMDs, which could also put you in a higher tax bracket and subject your Social Security benefits to taxation. Converting a traditional IRA to a Roth IRA and delaying Social Security, which reduces the number of years benefits are subject to tax, along with reducing your expenses by paying down debt, is a way to continue managing taxes throughout retirement. For most people, Social Security is not enough to live in retirement. You need to supplement your benefits with other sources of income. Making sure those other income sources are allocated correctly and aligned properly with your benefits is the single most important factor for maximizing Social Security benefits. Clearly, there are many factors to consider in determining when and how you take your Social Security benefits. Factors having to do with health, your life expectancy, your need for income, whether or not you're working, and the needs of a surviving spouse. Combine your individual decision with the decision of when it is the best time for your spouse to retire, and suddenly you are faced with hundreds of combinations that could affect the quality of your life in your retirement years. There are some other noteworthy changes to Social Security this year, including the following. You will receive a 1.6% increase in benefits based on your annual cost of living adjustments. Non-blind disability recipients will get $40 more a month, and you will be able to earn up to $50 more before any withholding kicks in. The maximum payout for those retiring at full retirement age increases to $3,790 a month, or $45,480 a year. Recipients will get a 1.6% COLA increase, as cost of living adjustment, in their monthly benefits this year. The income ceiling for workers contributing 6.2% of their wages to Social Security rises from $127,200 to $137,700, a change that is expected to affect about 12 million of the 175 million Americans who pay Social Security taxes. For recipients who still are working while they collect benefits, those younger than full retirement age can earn a maximum of $18,240 without being penalized, up from $16,920. As of 2017, Social Security statements are no longer being sent via snail mail. You now need an online account at ssa.gov in order to access the information. In addition, security measures for individual accounts have increased. You now need an email address or cell phone number as a second form of identification for accessing your account. Despite the availability of government resources to help you calculate your Social Security benefits on your own, the complexities of the system and the number of variables involved in successfully maximizing your benefits makes this a job for a professional. Remember, the most important factor for maximizing your benefits is coordinating them with your other sources of retirement income and making sure your asset allocation is secure and properly aligned with your Social Security strategy. A qualified financial advisor, ideally one who specializes in retirement income, can work with you to make Social Security the significant and dependable part of your retirement plan that it should be. I know we've covered a lot of information in this video. If you have any questions about anything I've covered, please do not hesitate to give us a call or send me an email, and we'll be happy to set up a free financial consultation